It's kryptonite to the typical financial advisor down here. Their livelihood is built on stocks and bonds, and normally if gold's going to go up a lot, it's usually happening for reasons that may not be as bullish for stocks and bonds. If you think about it, since 2021, well, it's actually outperformed them since the millennium, but here we are 4 years now since I got out of the equity market to own gold, and it's outperformed both of them, including bonds. And that's unheard of, because when I was a young financial advisor many decades ago, the sales manager would always tell you, listen, if you're worried about the stock market, put them in bonds because they never lose money. Well, bonds lost money the last few years and all. So I don't fully expect the general financial community to ever return to it. What I do expect is that gold mining companies now are basically going to print cash. Their free cash flow is just going to be records after records. Fourth quarter will be due out soon, but now with gold at 2,900, the next couple of quarters, and they'll be one of the few sectors that will probably see dramatic growth in earnings. Because the regular stock market is priced to perfection. Even the biggest bulls are not expecting a great increase in earnings. So that will help maybe get some interest from the financial service community, but they're never going to go back and own gold in a big way. They're just not. A couple of years ago, when I became so bullish on gold that I decided to own it versus even stocks or bonds, one of the beliefs was, and I stated back then to you and others, that the shifting of trading of gold from London, New York to Asia is going to kill the paper market, which has basically been manipulated at times, and suppress the gold market. And with that, you would eventually see the physical outweigh the paper market, and then gold could really take off. That was the thesis. And that's basically what's happened in recent days and weeks. For whatever reason, fears of tariffs, actual tariffs, whatever the case may be, the physical market has had such a strong run in recent days that has caused the paper market to really have huge issues. And also people that have to make physical deliveries and all. That's been innate. But the longer picture, which you touched on, is the real bullish one. So the BRIC nations, which a couple years ago when I got behind it and aided in me wanting to own gold, and I don't root for it as an American, because if I'm right about it, it's not going to help America, it's going to hurt America. But they basically decided that de-dollarization is here. It's only going to get weaker and worse to own over time. And not that they needed to create a new currency, because that was always talk that came out of bullion dealers. That was never something that the actual leading countries spoke about. But they needed to look for ways to trade without the dollar and around the US. And that really was the idea of the BRICS formation. If you talk to a country now and say, well, let me just tell you this. The United States, first they abandoned their allies, including Canada, when they left Afghanistan. Then in the Ukraine war, they froze the assets. They were the lead reason to freeze the assets of the Russians. And then they took the interest, which was entitled to be theirs, and give it to their enemy. And now the new guy on the block, meaning Trump, he's basically said, if you don't play with us, he's going to beat you down to the pulp. They're not going to try to get into a wall of words with him, but that's a marketing piece for those that want BRICS. And I think it's going to backfire on him speaking that way. Now, he does a lot of these things to position himself, the art of the negotiator and all. But that's a very, very bullish factor. And they recognize that whatever they do eventually in size, they're not going to be able to do it with just a fiat currency. They're going to need something of a real asset, just either between themselves or it ever grows someday to be something that others could be involved in that aren't part of the pack. And that's the reason for the accumulation of gold. Listen, the central banks have not bought all this gold and repatriated it for a trade, because who do they trade it to? They're not going to be able to flip it and make that money. So they have bought it on the belief that somewheres down the road, gold is going to play a more important role on how we live. Now, I may be past by the time that comes, but it's coming. What I learned a long time ago, and you had to lose a lot of money to learn this, it's not how much you make, it's how much you don't lose, which is going to separate you from the winners from the losers. So the good thing I feel about, even though I've been overall bearish on the market, is I never went short it. And therefore, what I did put my money in actually did as well, if not better, which was the physical gold and all. There's two issues, and I think this is very important. The market that I entered in 1984 as a young stockbroker doesn't exist anymore. 90% of the trading was retail investors. Institutional was minimal, and there was no such thing as computer trading. And people bought stocks for what the original reason why the stock exchange was there, where you could buy and sell part ownerships of businesses. Now, over half the money, almost 55%, they say, is in passive funds, which means these are funds that are not being actively managed, and they're basically being invested to track indexes or indices. Therefore, the manager, he or she, doesn't have the right to go and buy or sell individual stocks. Now, as long as the market's going up, more money pours into those, because over half of the money of new money keeps going in, and they kind of come like a self-fulfilling prophecy. I'll give you an example. The biggest indice that they use is something with an S&P 500 index. There's like 470 of them. Well, of the 470, 410 have Apple stock in it. So basically, as new money keeps coming in versus going out, Apple gets bought. It's one of the things that kept that narrow group up, because they make up such a significant part. But that will work in reverse if and when people start to believe it's no longer beneficial to be in passive funds that are betting on something long. It'll be the same way, because a manager will not be able to go, wait a minute, I don't want to sell Apple here. It's a very good company. They won't have no choice. Now, the rest of the money, about 75% of that, is in computer-driven related programs, algorithms. Some of them are just simply trades based on words and headline stories, and some are very sophisticated programs that include futures and options and all of that. The smallest part of the pie now in the stock market is people like me from 40 years ago that bought part ownerships of businesses. And therefore, I always tell people my age, I'm 68, but basically 55 and over, it's not the market we grew up in. You can't invest in the same manner that you did. Those are very, very important parts. And then there's one other, and this will not get me invited to Christmas parties here at the financial service firms in the U.S., but it's a fact of life. Almost 50% now of financial advisors giving advice in the United States weren't born when I started in this business. Now, that doesn't make me any better than them, but there is a lack of real experience, because for the most part, half of these folks have basically experienced a one-way street. They learned how to drive on it, and they do very well. They put the gas to the pedal, and the odd time when something went bad, this thing called the Fed came along as a tow truck, fixed everything, and was back to driving one way. If and when the market ever goes to a two-way street, or worse yet, a traffic circle, I feel that the lack of experience that people have will be a hindrance and cause more downside that otherwise happened. So I just take this attitude now that for whatever's left of my life and career in this business, is that I'm going to be a live chicken versus a dead duck. Currency, their stock, as their buying power to get new reserves. They're not going to all start grassroots production. They're going to go look at companies, make acquisitions, do strategic deals and all, and that will help the junior market. But the two big things that still anchor the junior market down and have held it back, it's not an excuse, it's a fact of life. I've lost money in these things to understand them. One is crypto. Cryptocurrency has taken the person or persons that might have otherwise went into the junior market 20 or 30 years ago, and they're now in the crypto market. That's where their excitement, that's where their speculation, meme coins. I mean, what's a meme coin? It's like you and I come out tomorrow and say, hey, we started our coin. You want to buy it? And it's just who wants the greater fool theory. There's no instant value. I can't use it for anything else. But that's where the hard speculative money has gone. And I don't think it's coming to juniors anytime soon again. The only way it's going to come is that slows down and people start to see how well the majors are doing. And as they go down the food chain and start making acquisitions, and suddenly 50-cent stocks are $2, that'll track it back. And the other thing is, I think the junior resource market is smaller today than it was 20 years ago. I don't think there's as many players as there were. There certainly aren't as many institutional players that once existed. And therefore, it's more of a challenge for junior resource companies to get financings and recognition and all of that kind of stuff. But everything else has clicked now for them. And the one thing that's stopping it is the logjam. When the majors finally not only just merge with themselves, but really go into the junior market with action, that'll be when we'll see the market take off. And it won't matter. It could be a gold company, it could be a copper. Copper and gold is probably the best two you can have right now. And then, some of the off metals and all, even uranium. But it's been very, very hard to make money in that unless you're the person in the private placement arena and that kind of stuff, or else it's been a challenge. So everybody still asks me about uranium, because you remember a few years ago when no one wanted it. It was probably my biggest single bet I ever made in the junior resource market. Uranium was under 20, things like Cameco were under 9. But in January of 2024, when uranium went above 100, I got out and I've never gotten back in. I did note a few weeks ago when there was a sharp sell-off that if it would continue lower, I would look at it again. It hasn't yet. It still may, even though uranium has a phenomenal supply and demand scenario. The difficulty that existed since day one, there's so few producers. There's actually only a handful that you could actually play. And every other metal has dozens, if not hundreds of different producers at all. And therefore, if you're going to play it, whether you're bullish now or in the future, you have to overweight in the producers and the people that only, because the rest are just, hopefuls, just like junior gold companies, which most don't end up succeeding at. But it has a bullish. The one metal that a lot of people aren't speaking about at the moment, but has turned up very nicely, and I've invested in it through a couple plays, and that's zinc. But it's not a metal that's going to go roaring through the roof where everybody needs it, but it has some very bullish fundamentals. I just think that the important thing to recognize is that there's no longer ample supplies of metals that they used to be sitting out there. And second, now countries are starting to become defensive of what they have because of their needs for it. And therefore, it's going to be more challenging to go and get new supply. My philosophy is this: the stock market is priced to perfection. Call it a speculative bubble, call it whatever you want. If the perfection doesn't continue, it has a good chance to lose a good bit. And my view is, if you haven't been in by now, or you've been in, and the older you are, the less you should have to that exposure of the retreat. The other factor is a capital preservation now, managing what you have. And the reason most people are still not caught up in that is because they're spending more than they make. Less is more. We have three big problems in the U.S. Our debt crisis, a retirement crisis, and an infrastructure and natural disaster crisis. And as good as Trump is in the eyes of some, and as good as he might have been in other areas, even he is beyond fixing those to a point where I don't believe they're not going to impact us in a difficult manner. And most Americans are not prepared for the fact that 2/3 of Americans are working without a paycheck, have little or no savings, are going to have to work well into their older age and impact. Trump has clearly not had any consideration to austerity. He's willing to spend and borrow because he thinks he can build the economy and drive it to the roof and all. And then the third is our infrastructure, which is absolutely crumbling, and our natural disasters, which when I wrote about this a year ago, I got people wrote me, like, what are you, crazy? Look what just happened in Los Angeles. That's going to be $500 billion by the time it's done and all. We can't afford one or two more of those. So there are a lot of things to be concerned about. But I think the overall attitude is less is more. Spend less than you make. And then once you're situated and hopefully not stressed out, then you can look at speculative things where trying to turn $1 into 2, 3, or 4. But remember, for everyone that turns $1 into 2, 3, or 4, more turn $4 into 3, 2, 1. And I've been one of them.